Hey there, my name's John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Let's talk about annuities and how they can beat inflation right now. So you might be wondering, what is the true inflation rate? How much should your annuity be producing to beat it or even keep pace with it? And there are certain annuities that are great for that, and I'm going to show those to you right now. I'll share my screen. We'll go over those. But as far as annuities, when you're looking for growth and protection, because a lot of times we want out of the market, but we still want growth, right? We want to beat inflation. And usually when you're trying to beat inflation, the common thinking is always go buy stocks, okay? But if you're older and you want to retire and you want safety, then that can be a very scary thing. And so there are some great annuity contracts out there that will provide that protection, even give you guaranteed income that will rise with inflation as well. And I'll show those to you as well. But a lot of times people will be put into the wrong contracts, especially if you're working with an advisor that maybe just manages money and they don't know a lot about annuities, then they can place you into whatever their broker-dealer suggests to them. But I work with thousands of products and I know the right ones to use for those, because there are just certain ones that I would recommend for those because they actually have good growth and they have a very good back history of growth. And that's what we want. We don't want you to go into an index that has been back tested and you're kind of the guinea pig and they're trying to test it out on you, because there's lots of new strategies, and it's not to mean that they're not well-meaning, but when they create these and they give you these huge participation rates, sometimes 200% or more, they're based off of strategies that they hope will work, but they have no idea until it actually hits the real world. So, and usually in the real market, it does not work the same, and they usually underperform by a large margin. Okay. So we're going to fix that. Okay. I'm going to show you the best options for that. We'll talk about inflation, and of course, inflation is all over the place. Some people argue that it's down at 2% right now, and some say, no, it's a lot higher than that. And I would argue it's probably is higher than that right now, just especially with tariffs. But of course, it depends on what you buy and your purchasing habits as well. So anyways, let's take a look, and I hope this is helpful. And again, if you want to book a call and you're thinking, I would like to buy an annuity with John, okay? You're thinking you'd like to use me to provide you with annuity advice, expertise, and you're thinking you'd like some help as far as purchasing the right annuity, then I'd love to help you. Book a call. There is a link below this video, and there's a link on my website, johnstevenson.com. And I'll show you everything that's available. Okay, I'm pretty transparent. I show everything. I mean, some of these I make high commissions, but a lot of them I make a lot lower in commissions, but it is usually, well, it's always better for the client. Okay. So that is really, really, really important. Okay. When you're working with an advisor, a lot of times they will show you the best options for them, not for you. Okay. And it's an okay option for you, but it's definitely the best for them because they're making huge commissions versus a product they'd make half commissions on, but are better for you. So anyways, just be aware of that. That is unfortunately the world we live in right now, and everyone has different priorities as far as why and how they recommend things. So as a financial fiduciary, I am obligated to show you everything that's available. Okay. All right. So take a look at my screen. You will notice that I have someone in here from Florida, $500,000, and it's a single male. Okay. Again, if it's a joint payout, it would be a different amount. But we're going to look at this level payout, and then I'm going to quickly go to the inflation protected, and then we're going to go into other products that aren't even about income at all, but they're still going to protect you from inflation. That's what we want. Okay. That is the goal of this video, is to show you what is out there, and then you can kind of decide what would work best for you. Okay. So if you're looking for lifetime income, and I would say this is by far the most popular option for lifetime income, is a level payout. Okay. Usually what people do is they'll buy a level payout for a base. Okay. They have their base income, it's covered. And then they're able to use a smaller amount of their portfolio, because if you want this amount, like for instance, we're looking at $500,000 taking income immediately for a single male. Okay, it's $3,200. If you're married, then it's going to be less, depending on the age of your spouse. So, but it's not a huge difference. It's like $100 difference in this case. And that's just because I made their ages the same. If your spouse is a lot younger, then that makes a difference as well. Okay. But if we look at this payout, it's level for life. Okay. It'll never change. It'll never go up. And of course, as inflation eats away at the purchasing power, the value of that monthly payment is just not going to be as great. And so we're looking at, $3,100 a month as a joint. It's not bad. But over time, you're going to want more from that. And so you can either do what most people do, which is they'll buy a base contract like this. They'll have high lifetime income that never goes down, and then they'll let the rest of their assets ride in the stock market. They'll let it grow, compound, and then every 5 to 10 years, they will strip off $100,000 to $200,000 and buy another annuity contract. And they'll keep layering their income as time moves on. That gives them a lot of flexibility with their funds, allows them to have a lot of growth in the market and also be able to more than beat inflation. Okay. So looking at this, we'll say, all right, well, that's great and dandy, but I need more income later on. I don't want to use as much. Maybe I want to throw $500,000 in this and then maybe throw out another $100,000 into a couple other contracts to defer them. That's a great strategy. So we'll say, and again, right after this, I'm going to show you the increasing ones with an actual COLA. All right, so 100,000, and these are just our extra contracts. Okay, we already got our $3,100 a month, but we want some more later. So let's say at 72. So in 6 years from now, we're going to take income, and I'm still on the joint here. It's from $100,000. So $100,000 is going to generate another $1,000 a month as joint income. Pretty good. So another $1,000 a month. Now we've got over $4,000 a month in income from 2 annuity contracts, okay? But at the same time, we also purchased a third annuity for $100,000, but that, of course, we wanted to defer that all the way till we're like 79, okay? And we're going to activate income on that one. So 79, it's $1,764 per month. Now we're at $5,700 per month in guaranteed income from only $700,000 in total annuity premium. Okay, pretty good. This is a joint payout. Obviously, if it's a single payout, it'd be more. So this is just one strategy. Okay, let's say you bought one more and you're thinking, I just like one more because I might need it for extra expenses, long-term care, or I just want more income, right? So at age 85, I want to be able to activate this other one. So it's been sitting there for 19 years now, growing. You've already activated your base contract. You've activated 2 more contracts. So you've been giving yourself raises, but now you want to activate your last one. Okay. So age 85, $2,500. That's pretty good. $2,500 a month. That's $30,000 a year from only $100,000. Okay. You take that out for another 15 years. It's a pretty good payout. Okay. And that's really the power of deferral. Okay. Now you've got your $5,700 a month coming in plus this. Okay, so we're looking at what, $6,200 a month? $7,200 a month. So that's really good. You're almost at $90,000 a year, just shy of it. And you did it with a relatively low amount of cash. So that's one way to do it. Now, we're going to look at increasing ones that you don't have to worry about. You don't have to worry about adding more contracts to. So, and I'll show you the income rider, and then I'll show you the SPIA with a COLA attached. So if we look at those, let's just go back here. I want to go back to our original goal. Actually, you know what? Let's go back to 66. 66, we'll say $500,000. Okay. All right, joint income of $3,099. So $3,100. That this is level, never goes down. But now I want it to increase. Okay. So it's not going to give you as much initially. Okay. And so you have to put more premium in if you want the same amount initially. All right. So Corebridge is the best one for that. Although Allianz is right after them. Whenever I'm looking at increasing products, I tell people to do Allianz because Allianz has a good track record for the increasing products. Okay. There's other products I don't recommend them for, but this is one I do. And so this one, let me just show you what it looks like. They give you a guarantee of $31,000 a year if there is no index growth. So they always have to show you worst case if there's a recession. Obviously, there is no increase. I'll show you the other ones where it's guaranteed, but this one is not guaranteed. Okay, now, if you look at the growth, this is the actual income you can count on. And I could say this is pretty accurate because I have clients who have these and they work very, very well. Okay. And they get this kind of growth. So it's not a huge amount of growth, but it is growth. It is increasing. You just don't have to worry about it anymore. So that is nice. And it's tied to the S&P. They're not giving you very much of it. As you can see, they're capping it like 4.25. But this, again, is for maximum income. So it's not a growth product. It's really just there to give you increases in income. And it's a great solution for that. Okay, now let me go to this SPIA. Okay, SPIAs are single premium immediate annuities. DIAs are the same. They're just deferred. So we'll look at those and we'll say we want a COLA. Okay, we want a cost of living increase. We want it guaranteed. And I'll just do joint on here, cash refund. Okay, I want to make sure it's apples to apples comparison because the The income rider will give you a refund of whatever is left in that account balance as well. Okay, now I'm going to go down and say I want a COLA, okay? And I want to compound at 3%. You might want 2%. I'll actually allow you to do up to 5%. So, all right, so it's a lot lower income, you see, $2,000 a month. Definitely less than the income rider. But you have an absolute guaranteed 3% increase every year for the rest of your life, no matter what. Now, what you're going to have to do, and I'd recommend you do this, go into ChatGPT and look at that and say, all right, $24,000 a year with a 3% increase, how much will that give me per year in income for the next 30 years? And then it'll lay out every single year. It'll show you what the increase is. And you'll notice by around year 14 or 15, it will equal the amount that you would have gotten on the initial payout right from the beginning for a level payment. And that's what stops a lot of people, because they're like, okay, I got to wait 14 years just to get to where I would have gone, would have started with my initial payout. A lot of times people just don't want to wait that long. Like, I'm going to be in my late 70s or 80s or, whenever you want to do this. And so maybe it's not worth it. And so maybe it is, but you just have to realize if you want that kind of income, it's going to be more expensive. So you might be thinking, I've got all the money in the world. I just want to make sure I have a certain amount of income that goes up 3%. Okay. Well, we can do that. We'll say, I need $5,000 a month. That's what I need. I need to be joint, and I need to have a 3% increase every year. Okay. What is it going to cost me? That's a very easy, simple way to do it. It's just more expensive. Yep. $1.2 million. So yeah, you're going to get $60,000 a year, no problem. And it's going to be increasing 3% every single year. That is great. You know what? Let me show you. Let me see if I can show you that real quick. So we'll go down here and we'll say ChatGPT. All right. What does a $5,000 per month income look like if it gets a 3% increase every year for 30 years? See, now you can kind of see exactly how to do this for yourself. You just got to ask the right question, ask it in the right way. But it'll compute it for you. You go down here and see, all right, monthly income. And again, this is doing in 5-year increments. If you want to narrow it down, it'll do it for you. But you can see here is what it looks like. In 5 years is 57. In 10 years is 67, 77, 9, and so on. Okay, so this is all right. Well, this is kind of how it looks increasing, right? And you look at that and say, okay, well, $5,000. $5,000. You know where I'm going. I'm going to go compare this right now. Okay, I'm just saying no increasing income. Okay, I want to do immediate. Let's go back to immediate here. Okay, and then I'm going to say, I just want monthly income. Okay, I want 5,000. Let me go back to increasing. Just show the increasing one real quick. Just so you can compare that with the SPIA. All right, see, it's not as expensive as the SPIA. You need $967, so you're definitely saving money there. Okay, it's not guaranteed, but it's close. I mean, it's with a good company with a good track record with these products. Now you might be thinking, well, I just want $5,000 a month. What is that going to be? Okay, I don't want it to increase. I want to just pay later for more increases. Now it's like $806. So now you're saying now it's like a $400,000 difference. So if you're thinking to yourself, I would much rather have this and then leave my other $400,000 in the market to grow and compound and buy more contracts later, that might be a better option. That's why I showed you both. Okay. As far as keeping pace with inflation with other products, I mean, I showed you income, which is the most popular, but I'll tell you, MYGAs right now are great rates. They're definitely exceeding inflation. Okay. So if you're looking at I'll just show you the top ones. I'll show you the top 3. Usually 5, 7, and 10-year options are the best for these. So you can see the 7-year paying like 6% around. The 10-year, yep, 6%. Wichita, but you might be thinking, well, those are B rated, so I want to do at least an A-, which is fine. There's some good B++, I would say. I usually, you're fine. It just depends on the company. All right, so we'll look at this and we'll say 5 years, 5.8. So we're still pretty close. The 7-year, 5.5. 10 years, 5.5. So there you go. And that's a great way to keep pace with inflation. In fact, more than you You're more than keeping pace. You're beating it. Okay. 5.5 is definitely more than inflation is right now. And so if you're looking at that, here's the ending contract value. Or if you just want to live off the earnings, you can do that as well. You take off the interest. So it's really simple. Otherwise, we could just throw you in an indexed annuity that has the right indexes. And if you're going to do that, then you need to go somewhere like Lincoln or Delaware. And I love these because they have good track records on their S&P index. Okay. And as far as track records, I mean, they have higher renewal rates than a lot of other companies that I work with. And that's what I want, because I don't want you to be stuck into something where they will reduce your participation and your cap rates much lower after the first year. And then you're stuck. That's just not a great place to be. So looking at Lincoln, I'll just pull that up here. I'll show you exactly what it's currently paying here. So let's see, S&P 500. We'll go down here and we'll say, okay, let's see here. We want this to compound every year. Some of these will lock in, participation rates of, point to point of 3 years, 5 years, 10 years. I don't recommend that. I would definitely have a compound, give your account, money, credits, earnings every year. You want that. All right, 500,000. Obviously there's no earnings in the index, then no money. But if the S&P does what it's done in the past, then you have pretty decent growth. And it's more than beating inflation. See, it's better than a MYGA for sure. Now, this does not have an income rider, so it's not giving you guaranteed income, but you can take income out, and you can just kind of look at it, and we can run some projections and say, all right, well, as long as you take out this amount, then your account should keep growing. Like, I can do that for you. But you just have to realize this is not guaranteed. It's a great way to protect your money, but also be able to have some of the market growth. So you may want to be out of the stock market, but you still want the benefits of the stock market. This is the best option. And this is definitely what I would recommend if you want that. You're going to get the protection from the stock market, and you're going to get some of the growth, not all of it, because they're only giving you 55% of the S&P. But it's still better than when the S&P is down 30%. You're not going to be so unhappy about that 55%. Okay. There is a cost of protecting your money. And the cost is they're buying call options, and sometimes they can't exercise those call options, and it costs them billions of dollars to do that. And so they share the growth with you when it does well. And when it doesn't do well, they cannot exercise those call options, and they're not making any money, and neither are you, but neither of you are losing. Okay. That's how that works. So this is how you fight inflation with annuities. Okay. I know this video was a little bit long, but I wanted to dive into this because this is a big topic, a big question for many retirees. And a lot of people wonder, how can I do this with an annuity? Okay. I heard annuities aren't growth products. Well, they definitely can't beat the stock market. Okay. But they definitely can give you other benefits that the stock market cannot give you. They give you contractual guarantees. They give you protection. Okay. They give you income if you want that. And so if you're looking to purchase an annuity, I'd love to help you. There is a link below this video. You can go directly to my calendar, or you can go to my website, johnstevenson.com, and you will see a link right there. And you can look at my annuity calculators. You can see what's available for yourself. And if you want to reach out, then of course we can chat at that time. So I'm happy to help. If you like the video, like, subscribe, share. I appreciate you for watching, and we'll see you next time.